Okay, second part of the lecture, how do we record inventory transactions? It depends on what system you're using, perpetual or periodic. If you have perpetual inventory system, then you will update your inventory account all the time and there will be inventory account involved. If you have periodic inventory system, then you do not have inventory account, and instead of inventory account you need to use some expense accounts like purchases, for example. So let's look. Suppose we purchase inventory, doesn't matter with cash or on credit. So if you have perpetual inventory system, then of course you will have more inventory, more assets, so debit inventory, and since you spend cash, so credit cash, or you will have liability, credit accounts payable. With periodic inventory system, then you do not have such account as inventory, and instead of inventory, debit inventory, you will have debit purchases, the expense account. The rest is same, credit cash, you spend money, or liability, credit accounts payable. So that's regarding purchases is expense account. So now what about sale of inventory? So first of all, when you sell something, you will get revenue, so it's credit sales, and you will get cash, debit cash, or if you sell on account, you will get current asset, accounts receivable. So if you sell the inventory and if you are using perpetual inventory system, so the first part of the journal entry is same, debit cash, credit sales, and the second part, you must update your inventory account. So now you sold inventory, you have less inventory. So you will credit assets, credit inventory, and you will get additional expense, COGS. So you will debit expense. What values you put? So as I mentioned previously, so if you sell something at $1,000, you will get credit sales 1,000, debit cash or accounts receivable 1,000, but when you update inventory account and determine COGS, you put 600, the cost of the inventory. Do not put the price, 1,000. What about periodic inventory system? With periodic inventory system, there is no inventory, so you will just get sales, credit sales and earn the revenue, and debit cash or debit accounts receivable, and that's it. Now, what about returns? Returns means that your client returns the inventory and he will not have that inventory anymore. But you will have more inventory because the inventory came back to you. So we need to look at from the perspective of buyer and perspective of seller, and let's start with perpetual inventory system as well. So from the perspective of buyer, so credit inventory and debit accounts payable. Why? Because the buyer no longer has inventory, so he will reduce his inventory account, and at the same time he does not have to pay for it because he returns, so his liability is reduced as well. So therefore debit accounts payable is reduction of liability. Now look at the seller. So seller gets initially when he sold the inventory, he credited sales. Now the inventory comes back to him. So therefore you may think he needs to debit sales. No, we need to have separate account to track these returns. So therefore we will have account called sales, returns and allowances. If sales is a revenue account, then sales, returns and allowance is a contra revenue account with a normal balance of debit. So therefore he will debit sales, return and allowances, and now he can no longer expect that they will pay him because they returned the item. So therefore he must reduce his accounts receivable in the same way as the buyer reduced his accounts payable. And now you need to update the inventory account as well. So now more inventory coming to you, the returns, so you need to debit inventory, and previously you debited COGS, determine the expense. Now your expense will be smaller because of the returns, so therefore you will credit COGS. You don't need to create the contra account for COGS, just operate with the same account. What about periodic inventory system? With periodic inventory system, no inventory is involved, so you look from the perspective of buyer. He will just reduce his liability, debit accounts payable, and there were purchases. Now there will be a purchase is the expense account. Now his expense is smaller because he returned the item, doesn't need to pay for it. So it will be contra expense account called purchase returns and allowances. The normal balance in it would be credit. Now look what will happen to the seller. We don't need to update any inventory accounts, so it would be just reduction in accounts receivable because the items are returned. The seller cannot expect to get any money for these items because they come back to him, and the revenue, sales revenue, must be reduced by using the contra revenue account called sales returns and allowances. The normal balance is debit for this contra revenue account. Of course, if you don't want to use accounts receivable, accounts payable, all that stuff, can just use cash. So just redo all these entries by put cash instead here, instead of receivables and payables. Then another thing that may happen to inventory, allowance or deduction. In this case, if you're not happy with inventory, you can return it. And the returns, we looked at them already. But alternatively, you may keep this inventory item, but since you don't like it, don't like particular feature of it, you may ask for deduction. The physical inventory is not returned to the seller in this case. So let's look first at the grant of deduction from the purchase price to prevent return of full inventory to the supplier. So now let's look from the buyer's perspective. So you will have debit accounts payable and credit inventory, but here you will put you do not put the whole value of inventory. You are not returning it, right? Here and here you will only put the value of discount provided, which may be 1 or 2%, right? Everything is very similar to the returns. The only thing is that we do not return the inventory item, and therefore the values here will be only the value of the discount. So the buyer does not need to pay that much as he was supposed to. Now he is given discount, so his accounts payable are reduced against the inventory. From the seller's perspective, it would be debit, sales, returns and allowances, and reduction in accounts receivable. But again, only the value of the deduction and allowance. So previously he debited accounts receivable, expected to get money for his inventories. Now inventories are not returned to him, but now he has given deduction and allowance to the buyer, and therefore the buyer will not pay the full amount but only small amount. Therefore you will credit accounts, the seller will credit accounts receivable, and simultaneously he needs to reduce his or her original sales. Original sales were credit sales. Now that sales must be reduced a little bit by the value of the deduction and allowance. You need to have for this the contra revenue account, sales, returns and allowances. And with the periodic inventory system, the idea is same. The only thing, you do not have any inventories, so now you will have you have purchases, and now for the value of the deduction and allowance you will credit purchase returns and allowances. So the buyer is now, since he is given the allowance and deduction, does not need to pay the full amount. He needs to pay smaller amount, and the difference will go into here. So his accounts payable will be reduced somewhat, right? And his purchases, his purchase expense will also be reduced somewhat. So this is a contra expense account, will be having normal balance credit. And the same idea for the seller. So his sales, original sales, will be reduced somewhat, and his accounts receivable that he was expected to get will be reduced somewhat. He will not get the full amount for the product he sold, somewhat less. And this somewhat less, the difference will go into here. Then the next thing that may happen to the inventories is the discount. Discount, particular type of the discount, if you pay within certain time period, you will get discount. If you make prompt payment. If you pay later, you do not get discount. And if you do not pay at all, then the case will be referred to money collectors and taken to the court and legal action and so on. Yeah, so this one is the discount for the prompt payment. Let's look at perpetual inventory system. If the payment is made within discount period, then liability will be reduced. First you need to reduce your liability. You need to find the actual cash that will be paid after the discount has been applied, and the difference between original value and the cash you get if discount is provided. The difference will go into the inventory account. For example, suppose the amount owed for the purchase is 5,000. Due to the discount, the actual cash paid for the purchase is 4,850. The difference is 150. So if you have 5,000 in the inventory account for this purchase, we did not actually pay this 5,000. We paid less, 4,850. So you need to credit inventory by the value of the discount. In other words, to make it simple, the value of the discount is credited to the inventory account. So when the buyer purchases inventory and manages to get the discount, then the buyer will have smaller liability, debit accounts payable. He will pay cash, but that cash will not be the value of the original purchase, but the original purchase minus discount, and the inventory will be credited by the value of discount. To make it clear here, the accounts payable is the amount that the buyer is supposed to pay. So 5,000 in our example was here, 4,850 was here, and 150 was here. With periodic inventory system. So the only difference here would be, so accounts payable still same. It will be debited, credit cash, but here instead of inventory account you will have purchase discount, because we are not using the inventory account, we're using purchase account. So will be 4,850 and 150. So we looked at the perspective of buyer. Now let's look at the perspective of the seller. So in perpetual inventory system, inventory will be changed. We must record it. So when business sells merchandise, inventory is leaving the building, and therefore amount and the value of inventory is changing. So let's look at the first part. The first part is what we already saw. It's the sale of inventories. So you credit sales, debit cash or accounts receivable, and then update your inventory account, find the COGS. That's usual thing. But then the second part would be debit cash, debit sales discount, and credit accounts receivable. And so again, here will be 5,000, 4,850, and 150 here, the value of sales discount. We need to use the contra account for sales, so the discount will go into here. And with periodic inventory system, the first part for the seller would be to credit sales and acknowledge the accounts receivable. and the second part would be pretty much same. So the cash would be 4,850 for 4,850, the sales discount 150, and the accounts receivable 5,000. Regarding the freight, so here you have different commercial terms. Wait a moment. Yeah, they are defined by International Chamber of Trade and Commerce. It's called Incoterms. So there are different terms of purchase and sale, and here there are different responsibilities. Sometimes the responsibility falls with the seller, sometimes with the buyer. And it is very crucial because you need to decide who pays for the freight first, buyer or seller. And say if seller is not supposed to pay for the freight, then seller will not record any freight, and vice versa. And if buyer is supposed to pay for the freight, then buyer will record the freight cost. Seller will not record, depending on what kind of terms and conditions you have. Of course, it's not only about freight and transportation, it's also about insurance, customs clearance, and so on and so forth. But let's suppose we are not preparing accounting entries for the payment of customs duties and all that. Let's ignore it for the time being. The email that I have sent. So first of all, first item. So if we what we do, we sell inventory or we buy inventory. If we sell inventory, then you will just record debit freight out and credit bank, and freight out is expense. However, if you buy inventory, then you may use debit freight in and credit bank, and freight in is expense account. You do this if you have too many inventories and they're cheap and bulky and you cannot attribute freight expense to particular unit of inventory, something small, then you will use debit freight in and credit bank. But if you buy expensive inventory, then you will debit inventory and credit bank. So the freight cost would be added to the cost of inventory. With periodic inventory system, of course, you do not have any inventories, and therefore with periodic inventory system you cannot use this one. The only way for you is to use expense and debit freight in against credit bank. For example, if you buy inventory worth, if you use inventory account, then you must add the original cost of inventory plus the cost of freight. So therefore, if inventory costed 15,000 and the freight is 3,000, then here you must put 18,000, and as well here 18,000. But if you are using freight in or freight out, then here you put only the value of the freight. Here you'll put 3,000, 3,000, and here 3,000 and 3,000. But if you use inventory account, you must add together the value of inventory and the value of freight. That's why if I use inventory account, the cost of freight, for example, is $30. Therefore, I put $30 plus original inventory value. So if original inventory value was 2,000, then here you would put 2,000 plus 30, 2,030, and here 2,030. But if you are using freight in, freight out accounts, you just put 30 only, without the value of inventory 2,000. And for freight out, so $25 paid for freight out, just put only $25. It doesn't matter what the value of the inventory is. Okay, the more important point, actually the first point you need to think about is who pays for the freight and for transportation, buyer or seller. So let's look only at SIF and FOB, because other terms this FCA, FAS, and XWorks are similar to FOB. And these terms CFR, CPT, CIF, DAT, DDT, DEB are similar to CIF. So basically you have FOB and CIF. But the thing is there is some confusion here to make it more complicated. So CIF is sometimes called FOB destination, and FOB as such is called FOB delivery, FOB shipping point. So you need to memorize this. FOB delivery, FOB shipping point is one thing, and CIF, FOB destination, is totally different thing. And so if you have FOB, the buyer pays the freight, and if you have CIF, the seller pays the freight. Example. So there is company called Excel, and this company Excel has supplier, and supplier sells to Excel something using FOB delivery terms, meaning FOB delivery is FOB. So the buyer pays the freight. The buyer is Excel. So supplier is seller, Excel is buyer, and buyer Excel pays the freight. So suppose the cost of shipping is $125. So the Excel is buyer, supplier is seller, so Excel needs to pay the freight and the FOB delivery. So in the books of Excel, it would of the buyer would be debit freight in 125, credit 125. Credit bank 125. Or if it is identifiable inventory, then suppose inventory is $2,000. So then Excel will record debit inventory 125 plus 2,000 cost of inventory, 2,125. Credit bank 2,125. And what about seller? A seller, according to the terms, does not need to pay for the freight, so he does not record anything, nothing. Okay. And another example, Eurospin purchased frozen food items 73,000 on FOB delivery. The shipping cost 5,500. Eurospin is buyer, same as previous example, so it pays for the freight. So it would be debit freight in only the cost of freight 5,500, credit bank 5,500. But if they decide to use inventory account, then you need to add the cost of inventory plus cost of freight, 78,500. Debit inventory, credit bank. However, if you have this term, the different case, Eurospin again purchased items, cost 73,000 in the cost of inventory, but the terms are different. Now FOB destination. FOB destination is CIF. So CIF, seller pays the freight, not Eurospin. So Eurospin is buyer, but seller of frozen food pays the freight. So therefore, debit inventory 73,000, credit bank 73,000. No freight is included because Eurospin, I'm talking here about the books of Eurospin. So Eurospin would not pay for the freight, so they will just record the value of inventory that they purchased, 73,000. But the seller will pay freight out 5,500. Credit bank 5,500, and so on, and so. So that's the example. The terms are very important because you need to know where your responsibility finishes and ends, and it must in the commercial contracts it must be clarified with very much detail where your responsibility finishes. Otherwise, there will be unpleasant surprises. And the terms, they're actually pretty same, but it much depends on the type of transport. Some of the terms are applicable for the road transport, some of them for air transport, and also there are other responsibilities like insurance, loading charges, and customs duties, and so on. Then let's look further regarding inventories. So you will record all the inventory transactions properly. Let's talk about perpetual inventory system. So you will record all of them, you will populate the ledgers. So you will have the ledgers looking like that. Then using these ledgers you can prepare the unadjusted trial balance. It will include merchandise inventory and COGS. But then at the end of the period you will need to make certain adjustments due to inventory loss and shrinkage. That's another name for inventory loss. So generally speaking, the shrinkage will be added to cost of goods sold. In other words, it will be expended if it is a small amount. But if it is a big amount at the end of the financial year, you discover that huge amount of inventory is missing. Then this shrinkage must be included into account called inventory loss. It's all subjective. What is big loss or what is small loss? Let's suppose that 2000 is a big loss. Then you will have the adjusted trial balance, and then you can prepare financial statements. You will have sales, and then all these sales, returns and allowances and discounts will be included, subtracted from sales, and then you can get net sales. And then you can subtract COGS and you can get gross profit, and then subtract all other expenses. And then you can transfer the net income here into the retained earnings using the income summary account. You remember that you cannot move the sales and expenses directly into retained earnings. You first need to accumulate them into the income summary, and then from income summary you will close it to the retained earnings. It's same as with all other companies, including those that do not have inventories, including services companies. You still need to close income summary to the retained earnings. And then the balance sheet, you will have current assets, and merchandise inventory would be here as well. So the closing entries. So the normal balance for the sales, it's a revenue account, is credit, so therefore when you move it into the income summary you will debit sales. But sales discounts are contra revenue accounts, their normal balance is debit, therefore when you move them to the income summary you will credit. COGS is expense, the normal balance is debit, but when you move COGS into the income summary you must credit it, and you will do it accordingly. So sales will be debited, and sales returns allowances, same as COGS, and sales discounts would be credited. So you will have in income summary account one side with 12,000, the other side with 9,926. So clearly the revenue side is bigger than the expense side and contra revenue side. So therefore we will have profit of 2034, and you will respectively move it into retained earnings in such way that retained earnings are increased and therefore credited. And for that you need to debit the income summary 2034. So that's how you do it. The adjusting entry can be made to the merchandise inventory and the cost of goods sold. Don't forget to make it. Or you may have inventory loss account, doesn't matter. That has to be done before you prepare the income summary. And then here we have the income summary balance, and it is transferred into the retained earnings. What about periodic inventory system? So you will do the journal entries. There will be no inventory account whatsoever, nothing. So you will record all that, and you will prepare unadjusted trial balance. Make sure that in unadjusted trial balance your merchandise inventory is zero, because it was not affected by any of these transactions. Then again you will subtract from sale these contra revenue accounts, sales return, sales discount, get net sales. Then you can find the COGS, then subtract COGS, and you will get the gross profit again of 2034. But remember that the opening inventory is zero, Nothing happens for inventory during the period, but at the end of the period, with periodic inventory system, you must count inventory, and therefore you will have ending inventory. You will. Then the closing entries would be pretty much same as with the perpetual inventory system, but here you will need to, at the end, at the point when you move items to the income summary, you need to include inventory. So remember that during the year you do not touch the inventories, but at the end when you counted inventory, you must include them. That's why you will have merchandise inventory ending here. And you will respectively transfer them into the income summary, and by transferring you will find the value of cost of goods sold. The value of cost of goods sold, just a moment. So first of all, you will add sales and purchase returns and allowances and discounts, and merchandise inventory ending would be added together with sales and contra expense accounts. You will add it, you will get 14,317. The opening inventory would be added together with purchases and other expenses and contra revenue accounts. You will get 12,284. The difference between them, these two items will go into the income summary and then transferred into the retained earnings. The difference would be 2,034. But you must include opening inventory and ending inventory, because let's look. The simple rule is to treat inventory opening balance like expenses. After all, they're on the same side of the inventory equation, because opening balance is on the same side as purchases, and therefore you will debit inventory opening balance, and conversely you will put inventory closing balance in credit. And as a last step, the credit and debit balances in income summary will be compared and moved into the retained earnings. Okay, so that's it for the inventory. Let's stop, and I will do the accounts receivable later on.